Hi, my name is Jim Bai, and I'm the founder of EverMarkets. I'd like to introduce you our platform and how we'll bring derivatives trading onto the Ethereum blockchain. Let me share my screen. I graduated from Carnegie Mellon back in 2005, and I started my career out on Wall Street. I worked for Citigroup for 6 years as a quantitative researcher and trader. Then I joined Graham Capital, where I was portfolio manager and trader. With another PM, I managed about $1 billion of futures and options. Our co-founders are Craig Austin. He's our CTO. We went to school together. He worked at Microsoft for 5 years and then joined AQR Capital. It's a $200 billion hedge fund. He managed their research development team and managed a team of 18 developers in building up their research infrastructure. Mark Pimentel is our third co-founder. We all went to school together at Carnegie Mellon. After CMU, he joined Citadel and has worked at Knight and Radix, and he'll be leading our market-making efforts. Other people on the team are Eric Rockstad. He's a developer from Microsoft. He's the earliest person I know who got into Bitcoin, bought Bitcoin at 25 cents. We've known him for 10 years. Same with Evan. He's worked with Craig back at Microsoft, and he's a fantastic developer. Worked at Microsoft, Amazon, Redfin. Jack Tan went to school with us. He's our business development person. He's currently in Asia looking for potential customers and buyers of our token. So let me start off with a background on derivatives and futures. So what a future is a contract that two people enter. They determine a price now to be exchanged at in the future. So that could be a barrel of oil or a bushel of wheat, could be stocks or even Bitcoin. CME just announced they're launching Bitcoin futures last month. And so anything with a price has a derivative. How futures trade currently is they trade on regulated exchanges. So there are only a handful of exchanges in the world that allow people to trade futures. In the US, future trading is done on the Chicago Mercantile Exchange. So they're the one exchange that handles pretty much most of US futures trading. In Europe, there's ICE and Eurex. And in Asia, there's a few centralized futures exchanges and clearinghouses. And I mentioned clearinghouses because that's the entity that backs every futures trade. Because you don't post the full collateral for these futures contracts, you need someone to guarantee the creditworthiness of each trader, and that is done by the clearinghouse. And I'll talk about that more later. And you also have brokers. Brokers facilitate the collecting of collateral and route orders to exchanges. And something that is, futures are known for is leverage. Leverage gives the ability of a trader to take on a larger position because they don't have to put the full collateral, full size of the order when they trade. For example, an S&P E-mini contract is about $125,000. But to trade, you just need to post about $5,000 of margin to trade this $125,000 contract. So here's a background on futures and where they are now. It's a billion-dollar business run by a handful of exchanges, like I mentioned. That because they are virtual monopolies, they have massive pricing power and high profit margins. The CME had profit margins of 43% back in 2016. Same with ICE. And futures revenues, they keep going up despite low volatility. They're uncorrelated to markets. So, and you can see in this chart, there's strong demand from Asia, particularly China and India over the last 10 years. And I just like to highlight the difficulty and how expensive it could be to trade these contracts. Whereas a high frequency trader can pay 15 cents with a seat on the CME, retail traders pay up to $3.40 per contract if you're a US retail trader. To get access to all these exchanges in the world can be very difficult, even if you are a large institution. Some contracts are forbidden to non-residents, like China, and they're centralized. And so they have, if you're a high-frequency trader, you can gain a speed advantage by co-locating your servers right next to the exchange. And this is something we prevent on the EverMarkets platform. I just like to highlight the difference between equity trading in the US and futures trading. So in equities trading, there are multiple exchanges and multiple alternative venues to trade equities. So one example is of this is dark pools. Dark pools are off-exchange venues where people can trade stocks. And institutions like this because they aren't susceptible to the toxicity, which is basically high-frequency traders that are trying to take advantage of them on the lit exchanges. So if you are an exchange and you have a large order, you'd prefer dealing with other exchanges who don't have the algos that would take advantage of your orders. And an example of an exchange trying to limit the effects of HFTs is IEX. They're introducing a 350 millisecond delay so that everyone is competing on price and not time. So what we want to do at EverMarkets is improve futures trading, simplifying the process, lowering fees. We have a unique market microstructure. Instead of a real-time limit order book, we will offer pro rata call auctions, and I'll talk about this later. And we want to bring all contracts to trade on the same platform, and we'll allow people to create their own contracts. And that's something I'll demo going forward. So this just to reiterate, this is what EverMarkets is building, a platform to trade any futures contract from around the world on one platform at a fraction of today's cost with minimal market impact. So before I go over how we do this, I just want to show you what a centralized clearinghouse versus a decentralized blockchain clearing, how that works. In today's world, the centralized clearinghouse is one entity. Right now, it's the CME that holds and keeps track of everyone's positions and everyone's collateral. What we want to do instead is to bring clearing on chain, and that is the innovation. One of the key innovations that we're developing. So instead of a centralized clearinghouse where traders face a centralized entity and where the clearinghouse guarantees all trades, we want to facilitate a decentralized clearing mechanism for the trading of derivatives. And in this manner, we want to build trust based on transparency, based on collateral that's posted and viewable and verifiable on the blockchain. So currently, trust is based on the reputation of the CME and other exchanges, and billions of dollars of the clearinghouse's capital. Instead, we want to build trust through blockchain and through smart contracts, and this is how I'll go over how we do this going forward. So these are our advertised features. We want to create a platform for everyone to access market fairly. So instead of competing on price, where HFTs can have co-located servers, place faster orders, we eliminate the need, the benefits of faster servers or faster market orders. We want to lower fees. We think using blockchain, using smart contracts, we want people to compete on fees, on borrowing rates, lending rates. Because everything's done on chain, there's no infrastructure costs for the platform. We think markets will bring prices lower and competition will bring prices lower. We want to allow anyone to participate. We want anyone in the world with even a tiny amount of cryptocurrency to be able to trade on our platform. And we accomplish this by allowing people to trade fractional units. So like I mentioned before, each E-mini contract is about $125,000, and you can't trade anything smaller. We'll allow users to trade a fractional contract, so there's no count minimums to open to trade. We're going to talk about the minimum market impact that you'll have because of the auction structure, and we want to provide real world contracts that exist today. So I just want to go over some participant roles on our platform. There's roles of a trader, people who want to hedge or people who want to speculate on different assets. There's a margin syndicate role, people who lend out their tokens to earn a carry, to earn fees. And there's a matching engine contract creator. So these entities, these users, launch their own futures contracts, stake their tokens, and then earn fees from traders to that trade this contract. And we facilitate this all through the Ever token. It's used as collateral for traders to make trades. The margin syndicate, they stake their EVR and provide leverage and earn carry. And the matching engines vote. So basically, people who create contracts, they need to solicit other users to back their contract, and that's how the people vote on what would be the de facto liquid contract of an underlying asset. So I mentioned before the market microstructure that we're innovating on, which instead of a real-time limit order book, we provide a pro rata call auction. So periodically, we'll pool orders, allowing people to will allow buyers and sellers to transact at one price. And this has shown in many academic studies to be a better way for traders. Traders who don't need the immediacy of a real-time book benefit in multiple ways. One is lower volatility, because we introduced a time separation lag. There are more orders that can be pooled, so you'll have less things like flash crashes. Traders will also not pay a bid ask. People pay one mid price when they trade as an auction. So we line up the buys and the sells, and we cross at one price called the crossing price, and everyone pays that price. So there's no bid ask to pay here. And it's perfect for a decentralized network, because we don't need to transact in microseconds. We can allow, we can take advantage of the fact that there is some lag in processing blocks. And so having a 15-second block time for the Ethereum network doesn't slow us down. We're just calling one function on the smart contract to cross traders. Yeah, I guess this is just summarizes the benefits of these pro rata call auctions that I just mentioned. Eliminates the speed advantage. This means people are competing on price instead of speed. So instead of HFTs or funds spending millions of dollars shaving milliseconds or microseconds off their algorithms, they can devote that time into creating algorithms that improve price. So there will be better price discovery for users on our platform. It's better for stability, like I mentioned. It's better for regulators as a surveying tool. You don't have that much data to parse through, and same with, and it's a fair means of transmitting data. So these are all the benefits of periodic call auctions, and we are implementing that on the EverMarkets platform. I'd like to highlight Mark's role as a market maker. We're going to be the first market maker on our platform. So building an exchange is not enough. We want to build liquidity, and Mark will spearhead the market making and liquidity provisions team. And this is one way that we're going to bootstrap liquidity, is to have our own team take the other side of trades. We're gonna try and fill as many traders as possible if there is an auction imbalance. We're gonna create tight two-way pricing, and this is what we're doing. We have deep experience. Mark's worked at Citadel and Knight, and he'll build a team out to provide a link to the real world. So we'll have our market making algos create two-way pricing throughout the day, and then if there is an auction imbalance, our algos will dictate whether we should hold on to the risk, or more likely we'll hedge on the real exchanges. So this is one way that we can link the two prices from the traditional exchanges and the EverMarkets platform. And then also we have experience knowing how to bring people onto the platform. So we'll be able to hire the right experienced sales and marketing personnel to go out and source traders, institutions, and other investors to trade on our platform. And then we're going to find third-party market makers. So this is how we can build the liquidity on the platform. And this is something that many other funds or many other platforms, whether it be exchanges or prediction markets, don't focus on. And we think this is necessary in order to create users, add users, and improve the network. You need to go out and source liquidity either internally or externally, and we'll do both. And so let me just go through now a demo of what we have right now. So this is the platform we have running on the RinkB testnet. We have these contracts that are launched that we're able to launch. You can see we have traditional futures contracts. These are equity index, like E-mini contracts, NASDAQ futures. We'll have commodity contracts like oil or natural gas, soybeans. We'll have single name stock futures. So Apple, Facebook, Microsoft, we can launch pretty readily. We'll have crypto futures on here, Bitcoin, Ethereum, different crosses as well. And this is something I want to highlight is the ability for users to create their own contracts. So people who have different risks who want to hedge in some contract that doesn't exist today, will allow them to create their own futures contract. They define their certain parameters of that contract, like initial margin, maintenance margin, and they'll provide a backstop that they need to post. And then you need to define an oracle. So this is how we, at contract expiry, a user is required to, a user is required to define an oracle. And an oracle publishes a real world settlement price on chain. And this price is used to return collateral to traders. And this is how we ensure the link between real world exchanges and prices on the EverMarkets platform. But once a user creates and defines those parameters and chooses an oracle, they're able to then launch this future and have anyone in the world trade this future. And then they'll earn fees. So if you're able to source a credible and reliable oracle and someone isn't, people will gravitate towards your platform. So we want the market to decide which oracle or which contract will be the most liquid contract. We want people to compete to source the most reliable and trustworthy oracles. And we want the market to determine the best contracts to trade. And so we're using the market forces to source better contract creators, better oracles, better contract parameters. We don't want to be a centralized entity defining all these parameters. So that shows you the creation of a contract. Let me show you how one can trade a feature on this platform. So right now here are just two contracts traded on in our portfolio. We have this E-mini contract, this S&P December 2000 contract. This is our required collateral. This is our excess collateral. Then this is our position right now. And so we have about $1,000 in our private wallet right now. We're using MetaMask as the interface to handle transactions, transferring funds between our private wallet and these smart contracts. So let's say I wanted to post a trade. I still have 3,700 tokens available. But let's say I want to trade a larger size, so I'll post collateral. This is analogous to wiring funds from your bank account to your brokerage account. So it'll ask, submit, confirm the transaction. This transaction is being submitted right now. I think it's being mined right now on the RinkB testnet. Should take about, let's see, 15 to 30 seconds. It's a little slower. The testnet is a little slower. Okay, so there it was. It was posted. We went from 30 4,700 to now 4,200. If you missed that, we can post again. Let's post 500 more tokens onto the smart contract. Submit. So this transaction's being mined. We can demonstrate this. It's being mined on, you can see this on Etherscan, Rinkeby right now. It's a transaction from one's private wallet to the smart contract that we've deployed onto the testnet. Okay, so good. So we posted, we have 0 balance in our private wallet. All our collateral, all our tokens are posted on these smart contracts, and we can start trading. We're currently short 5 right now, or short 0.5. We can go short again. Let's say we want to sell another contract at 2,500. You know, we'll have this. This is our order entry front end. There's already a buy. A trader has already submitted a bid at 2,500. We're gonna cross him with our one lot order to sell at 2,500. So this is just for demonstration purposes. We'll call this auction, which means it's a transaction that's now also being mined. It's one function call that'll find the match the buyers and sellers, and then lock in collateral. So I recall we had $4,700 in our as deposited collateral on the smart contract. Once this transaction is complete, we can go back and see our portfolio. So you can see we went from 4,700 to now 4,200 as collateral that we can withdraw back to our private wallet. But our deposit collateral, required collateral, went up. So this went up from 250 to 750, and we're now short 1.5 versus 0.5 when we started the trade. So that's a demonstration of 2 traders doing peer-to-peer trading without a centralized clearinghouse, and the clearing is done all on chain, and you can view this collateral that's posted in real time. And anyone in the world can view the collateral that's backing the system. And one more thing I can show you is we've started these daily contracts. Actually, yeah, let me show you the daily contract. So right now we can withdraw. So like I said, we can withdraw this collateral because it isn't being used in any trades right now. We can take it back to our private wallet. It's being mined right now. We're currently working on margin lending. So this is just posting directly onto these smart contracts. But in our next release, we'll have margin providers. We're working on the margin syndicate aspect. And then you'll post onto one margin pool, and then you can trade various contracts. Currently, we got to trade, post collateral onto individual contracts. Let's say, we want to post collateral again. So in the next version, this won't be needed. You'll just have one pool of funds that you can start trading from. Okay, so we have enough collateral to trade. Here, I'm going to submit one order to sell as a market order. And so you can see in real time what the book should look like. You can see you can see buys and sells, an active market. This is what a trader should see once we go live. People posting bids and asks. You'll have a cross automatically every, let's say, minute or 5 minutes. So instead of having to do this call manually, this will be all done automatically. And the trader doesn't have to know there is even, their trades being cleared on chain. As a trader, as a derivatives trader, you don't care, what is guaranteeing your trades, how it's being handled, but you just want to know that the P&L that that you realize is what you expect. As if you trade on the CME and you traded an E-mini contract, there should be no difference in P&L if you trade on the EverMarkets platform. So there again, we show that we were short one, we sold one at market, we sold it at 25.64, and we went from 1,000 in our excess collateral. We posted 512 tokens, and yeah, so we're excited to develop the next version to be launched. So we're launching the beta, and in the first quarter next year, where people can become margin syndicates, we'll allow to trade with leverage any contract that people desire. We'll launch our public token sale around the same time in the first quarter. We're currently opening our tokens to a pre-sale, and pre-sale buyers for institutional accredited investors in the US or non-US citizens. And we're getting some questions, so I'd like to spend the last 10 minutes with answering questions. First question, is it possible to scale and speed comparable to classic trading tools? Yes, because we're doing orders off-chain. Right now we're doing off-chain order book and on-chain settlement. And as I mentioned before, we're doing auctions, so we can just call the function to lock up collateral every minute or so. So the speed of the blockchain doesn't really impact our crossing or our collateralization. The biggest challenges we see ahead would be both, well, technical, but also there's regulatory challenges to understand how regulators might feel about a decentralized clearing mechanism. When they wrote the Commodities Exchange Act, there was no possible way to clear in a decentralized manner. So everything in the Commodities Exchange Act is about centralized clearing for the trading of futures and derivatives. And so we need to explain to the regulators that for the first time, it's possible to clear in a decentralized way without one entity holding on to funds. And we think, given the benefits of a decentralized clear, where there's no central party holding onto client funds, we don't hold on to any private keys. It's a much more transparent way. People can view in real time the collateral that's backing the system. We think all these benefits should assuage the fears that regulators may have about decentralized clearing. How much is it to trade stocks, bonds, and gold? Well, we're letting the market decide what the rates would be, what the appropriate rates. So margin syndicates will charge a fee for lending out their tokens, and they'll set their daily lending rates. Contract creators will set their fees that they would like to receive. We feel that the fees will be much lower than the traditional exchanges because people are actually competing on price. If you're a CME, you have no incentive to lower prices to offer to your traders, so there's that's why they can charge what they charge, because they are a monopoly. And if you want to trade an E-mini contract, you can only go to the CME. If you want to trade WTI, you can only trade it on the CME. And each futures exchange is a virtual monopoly. It's a government-sanctioned monopoly. So we feel that costs will be lower, and in addition to lowering costs, we have lower infrastructure costs because people are, we don't run any servers. There's no centralized party maintaining hardware. So because of that, we think costs will be much less. How will you do order matching for large transactions? So large transactions are done the same way as a small transaction. You can place orders, limit orders onto the book. Just you can trade 1,000 lot, or you can trade 1 lot or 1/10 of a lot. So it's done all. So the orders are done centralized. There's no difference for a large institution or a small retail trader. Everyone pays the same price. Alex 2X asked, the EVR is a bridge currency. It is a currency. It is also you can think of it as a seat on the exchange. You need this token to access the liquidity that's provided by EverMarkets. And in addition to acting as an exchange seat, you can use that as collateral for the facilitation of trading. So people can deposit or stake their EVR as collateral and then gain exposure to the different underlying assets that are traded on the exchange, on the platform. Well, we're creating a decentralized futures derivatives platform. No one's been focused on the trading of derivatives for the crypto ecosystem. And you can think of us as another, we're creating the infrastructure needed to trade different assets, trade futures on different assets using cryptocurrency as collateral. So currently today, if you wanted to trade these futures, you need to open a brokerage account, deposit fiat, and then access the exchange through brokers. What we're providing is another way to access these assets without going through all that. So all you need is some cryptocurrency, our tokens, deposit onto smart contracts, and then start trading with any other trader around the world. So it's peer-to-peer derivatives trading, facilitated, like clearing is facilitated through smart contracts and through the blockchain. And it's a generic infrastructure. We're asset agnostic. People can trade traditional futures contracts, but also launch their own futures contracts. If you want to have, we were talking to a developer the other day. He wanted to trade, Ethereum gas futures. There's no other platform right now where you can just get exposure, or, hedge your Ethereum gas risk, right? And so someone here could launch their own Ethereum gas future, launch it on the platform, and then people can start trading. So that's one example of the innovation that we hope to see. We hope to spur this innovation in the contract creation. And I think, this is a necessary tool. Once you have derivatives trading for crypto, you can be able to hedge various risks that presented to different people. And we want to democratize access to the capital markets. And that's our focus, bringing the capital market with any amount of crypto. So that's how we differ. No, I think it's a hard problem to tackle. What we see are these prediction markets like Augur or Gnosis trying to tackle this. We see some people trying to do decentralized token exchanges, but no one's trying to focus on what we think is the bigger picture, is derivatives trading of any asset class, of traditional assets. And this is something that takes a team of engineers, developers, traders to understand the infrastructure that is required right now to bring it together. And what I feel is we have the strongest team to do so. We have traditional finance experience, we have development experience. Understanding how things work is something we've been doing for the last 10, 12 years as professionals. It takes a large experienced team to pull this off. And we currently don't see as strong of a team right now to do it. It's the Decentralized Oracles network. Are you developing smart contract interface? Decentralized Oracle network. Yeah, so we'll create the interface for people to, right now that's not our focus. There are other people working on oracles, but that is something we'll need to consider, how to make it as easy as possible for people to source the most reputable oracles. I haven't taken too deep of a look at Link. So going back to the oracles, we think the solution to the oracle problem is to have people source the most reputable oracles. We want people to find oracles who have a real-world reputation back their contracts, right? If we don't think that anonymous oracles are necessary or required to post a settlement price, people should be able to leverage the reputation they've built in the real world to post settlement prices. And so That's our view on the Oracle question. I'd like to thank you for this opportunity to present EverMarkets. We're busy developing. We're here in San Francisco. We're actually just leased a house in Palo Alto. So if anyone would like to stop by, talk to the team, feel free to message me later and we'll set up a meeting. But yeah, I appreciate your time, and hope you can follow along over the next few months as we launch the beta and conduct our ICO, our public token sale. And with that, thank you very much.